What's up everyone, it's Karthik with MoneyVest. So in this video, I'm going to break down the Magnificent 7 stocks. We're going to be going over the entire technical analysis on these 7 companies, as well as the Magnificent 7 index, and also a lot of other technical indicators and market breadth indices as well. I am a little bit under the weather, as I mentioned in my previous video, that I woke up this morning with a very severe headache, with a mild fever, some cough, some body aches, and just overall feeling not so great. So I am, of course, working towards getting back to normal, but I wanted to again do this video so that you can make better decisions going into next week, considering that 4 out of the 7 magnificent companies are going to be reporting earnings. So we've got Apple, Amazon, Meta, and Microsoft reporting their numbers next week. As you can see over here, Microsoft's reporting on July 30th, on Tuesday after the markets close. Meta is going to be on Wednesday after the markets closed, and Apple and Amazon's going to be reporting on Thursday after the markets close as well. So big week coming up here, and that's exactly the whole point of this video, is to give you a bit of a technical update on where we are with these companies and what to expect going into next week. So hope you all enjoyed this video and find it helpful. All I'm asking in return is that you drop a like and subscribe to the channel. Also, do check out the Patreon link down below if you want to get access to the entire MoneyVest platform, as well as the members-only private videos and all the trade alerts and trade ideas that I'm going to be sending out to everybody in our Discord, as the buying window continues to be pretty decent here, as markets are again in a dip/pullback at the moment. So as we have already talked about this in our previous updates, that the S&P is in a dip, the Dow Jones is in a dip, NASDAQ's in a pullback, Russell 2000's in a pullback, the entire Magnificent 7 is in a correction, and that is going to be this index over here. So if you come down, this is the index that we have created on our TradingView charts, and this right here, from its all-time highs of 2000, it is still down a little bit over 12, almost 13%, to now trading under 1800 points, and as a result, it is in a correction at the moment. NVDA is down almost 20%, so in a correction. It was in a bear market up until Friday, when it actually rebounded a little bit. Apple here in a pullback, down over 8%. Amazon down 9% in a bit of a pullback as well. Tesla is the only Magnificent 7 company that is still in a bear market, down over 40% from its all-time highs. And then we got Meta, Google in a correction, down double digits, and Microsoft also in a pullback. It was in a correction, but then Friday, of course, rebounded a little bit back higher. So coming over to some of the technical indicators, first things first, let's talk a little bit about the MoneyVest index. We are at 3.69. So we did bounce off of that 3.5 level. We in fact came down to as low as 3.48 was the low from the recent week here. And then of course bouncing right back up as the markets recovered. Volatility came back down. As you can see, the VIX was down over 11% on Friday, trading just a little bit over 16 at the moment. So what this essentially means is that, buyers once again stepping back in. There was, again, a lot of momentum and some technical rebounds in the markets on Friday as the VIX comes down. S&P, the MoneyVest index kind of rebounds a little bit from that 3.5, but we are nowhere near close to where the risk reward can be considered super favorable. This is still a small sort of dip for the S&P because it's still only down 3.6%. That is literally nothing in the grand scheme of things. I mean, the markets are, very occasionally down over 3%. And the reason why this is so important is because it captures their difference maker. It captures the rarity. And that, at the end of the day, is what really matters to the market. Said another way is that anybody can really buy when the markets are pushing higher and they're trading at all-time highs, right? Anybody can invest when the markets are moving to all-time highs, they're trading at all-time highs, but very few people can actually put emotions aside and execute when the markets are trading down in a correction or a bear market or a crash, and when they're down over 15, 20, 30% from its all-time highs. So that's exactly what we're here to capture. That is the difference maker over the long term. Long-term investment and successful investors, more specifically, make the difficult choices when everybody else is selling or is essentially selling out of fear or panic. Successful investors know that that's an opportunity because it's a discount. And it's actually quite interesting that when there are sales, when there's discounts in a retail store for clothing, for shoes, for watches, for cars, for whatever it might be, when there's a sale, a lot of people line up for those discounts. But when there's sales in the market, when there's discounts in the market, nobody lines up. If anything, everyone starts exiting the market and starts selling stock. And the cool thing is that is actually going to never change, regardless of how much we talk about this, it is never going to change because that is human nature. That is human nature. That's how we operate on emotions so much, is because so much money is involved. And that's why people who operate on emotions, especially when it comes to investing in the markets, oftentimes end up making the wrong decisions at the wrong time, selling at the very bottom, buying at the very top, and in fact, when it's supposed to be the opposite of that very thing. And Bill Ackman also talked about it during his podcast interview with Lex Friedman. Super amazing podcast, definitely recommended, over 2 hours long. But Bill Ackman essentially talks about this very concept that when the markets are going down, when stock prices are coming down, that's usually one of the best times to be deploying cash and capital into the market, because you're able to make smarter and more informed decisions at lower prices, at discounted prices. So that being said, if you come back over to the markets, and the first things we're going to analyze is going to be the S&P 500 stocks trading above their 200 simple moving average. So we are seeing a little bit of that momentum back higher on Friday, up over 5%. So this number is trading back up to over 75%. So this simply means that 25% of stocks are trading below their 200 simple moving average. And this number was as recently down to 62%. And if I bring up the technical analysis, going over to the weekly chart, you'll notice that this right here was the entire analysis. And the moment it gets up to as much as 85 to 95% is when we need to be extremely careful, because then the majority of the market, over 90+% of the market in the S&P 500, is trading above its 200 simple moving average. And the opposite is also true. The moment this number comes down to, let's say, 60%, ideally under 40%, best case scenario 24-25%, an absolutely no-brainer scenario in the low double digits, or even in the single digits. For example, this was during the pandemic, when this number essentially came down to under 2%. So you can just kind of logically think about how brutal that selling pressure was, that only 2% of the S&P 500 was trading above its 200 simple moving average. Over 98% of companies were trading below their 200 simple moving average. So this is another really important market breadth indicator for us to track and of course follow. And the support level for this is going to be 63% down to as low as 37%, with a very, very important area of resistance and area of supply, or really just where the markets are going to start becoming overbought here and overextended, is going to be 85 to 95%. So we're kind of approaching that level very, very soon. Now coming over to this right here, percentage of S&P 500 stocks trading above their 50-day moving average. Very similar concept, except the 200 SMA, we're using the 50 SMA in this example. And again, we've kind of marked out the red zone, which is exactly the level where we need to be a little bit more careful and understand that the moment we get up to that level, it's going to be time to, maybe offload some risk here, or take some profits off the table, because every single time we've gotten up to that level, it's going to be seen better on the daily time frame. You'll notice that every time we actually get up to that level, we see the markets coming down. This right here, once again, markets rolling over. This right here, a couple times, markets rolling over. This right here, again, markets coming down pretty aggressively. This right here, once again, markets coming down. Over here, back in January of 23, markets coming down. In fact, it came down to as low as 6.8%. This right here was back in December of 23, a little bit of a pullback. This right here was April of 2024, came down to 27-28%. And right now, the next time we get up to that level, once again, we're going to be a little bit more cautious with where we are with this particular index. Now, coming over to individual stocks. Now, Apple is down let's take a look. So Apple is in a pullback, down over 8% from its all-time highs. Next support for Apple is going to be sitting roughly at $206. So that's kind of aligned with that previous support from back in June 21st. So that is going to be that next level, and resistance stays put at around 220. And if you come over to the 30-minute time frame, it is very similar to what we have witnessed for the NASDAQ and for the S&P 500. So what you'll notice is a little bit of a lower high for Apple. As you can see, lower highs and of course lower lows also forming for Apple stock. So it is very clearly in a bit of a downtrend at the moment. So I can also point this out by this one over here. So you can see boom, 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 continues to sell off. And this right here could be that next support level to watch for Apple at $206 per share. If we're able to get a nice breakout above this $220 resistance, then the next target for Apple next week is going to be this level right here, so roughly at 227, and then I would feel a lot more confident that we can actually start moving back higher to new all-time highs. So the first resistance to watch is going to be this at 220. And in case we see some type of more weakness, we've got unemployment numbers, we got the Federal Reserve Chairman Jerome Powell's speech. So if you do see some more weakness, $207 is going to be that support, and a potential breakout is going to put us on the map to getting up to 227 once again. Comment down below, what is your technical analysis on Apple? I would love to know from all of you. So again, we've got a lot of really experienced traders and investors. So I would love to know what you think about all these Magnificent 7 companies for the next week in terms of technical analysis, so we can get a discussion going. So definitely do comment down below in the comment section. What is your analysis on these companies? Talking about Amazon, Amazon also continues to trade in a bit of a downtrend as it continues to make some lower highs and lower lows. So boom, right here, lower high, lower high, lower high, and lower low can be argued over here for Amazon stock. So once again, very similar to Apple as it continues to trade to the downside. This right here is a bit of a lower high and lower low pattern. Now coming over to the daily time frame, you'll notice that it's also at the same time forming some type of a head and shoulders. So we got a neckline at 173, resistance all the way up to 189, and we got a left shoulder, a right shoulder potentially forming here, and then we've got a head with a neckline at 173 as I mentioned. So if Amazon were to, let's say, push higher, get rejected at 189 again, came back down to 173, then the right shoulder would be complete, and there is a possibility for us to see a bit of a breakdown below this level, and the next target is going to be 166 for Amazon. So yes, technically speaking, it doesn't look super well or super bullish at the moment, with a resistance staying put at 189, massive support at 173, and Amazon's also reporting earnings next week with $151 billion in revenue expectations, with an EPS estimate of just over $1 per share on Thursday, August 1st. So 173 support down to 166 for this company. Tesla reported last week, so again, you can actually toggle between previous weeks and future weeks. So right now we're going back to the last week here. Tesla reported revenue of just over $25.5 billion, miss on EPS of over 52 cents per share for the company. But right now it's in a bit of a no man's land where it continues to consolidate sideways after the gap down post earnings, and resistance going to stay put at 232. So this right here, a very, very important level to watch for Tesla, and support level is going to stay put down to $207 per share. If you come over to the 30-minute time frame, you'll notice ever since the breakdown from Tesla here after the symmetrical triangle formation, where it was making lower highs and higher lows, it broke down. It's really just been consolidating sideways. So it's been getting rejected at 226 and validating 215. So that right there is the range within which Tesla continues to trade in between. So a much stronger support sitting down at $208 and a much stronger resistance sitting roughly up to 223. So it's in the middle of those two support and resistance levels, and that's exactly what we have to watch and wait and see how Tesla behaves moving forward. Talking about NVIDIA, and NVIDIA did break down from its support of 118. This right here was the entire sort of analysis where we have seen NVIDIA consolidate sideways before breaking out to new all-time highs quite aggressively. This was almost a 300% rally, then consolidate sideways again, and then another pretty significant 136% rally. And this right here was a consolidation once again, and then another 70% rally for NVIDIA. So right now it is starting to come down, almost 20% down from its all-time highs. And the next support, more important level, is going to be sitting put at $96 a share, with a very strong resistance at $117 for NVIDIA as well. So a lot of consolidation as we witnessed for NVIDIA. But once again, if you come over to the 30-minute time frame, what you'll notice is once again some lower highs here, and then also some lower lows potentially forming for NVIDIA as well. So next target is going to be down at $96 with a resistance that we're watching at $118 a share. If it's able to, let's say, break out of this level next week, then the next target is going to be potentially back up to all-time highs. Maybe one more target prior to that, sitting roughly at 135 up to as much as 139. So that $4 or $5 range is where we're going to be watching for NVIDIA moving forward. Going over to Google now, and Google also very similar to Apple and Amazon's also been rolling over. It is still in a correction, down over 13% from its all-time highs, especially after the earnings. It has sold off quite aggressively, and it's now trading down to a very important support. Now, Google is one of the only Magnificent 7 companies that I believe is a bit of an overdone move to the downside. You can see the RSI, the MACD, everything just incredibly oversold here as it continues to slide lower. RSI is down to 31, and it's also trading at a very nice area of support here inside this green rectangle. So I do believe that Google has maybe some potential here from a reversal trade standpoint, considering how much it sold off, with a first target and resistance at 174 up to as much as 179. And in case we get a much bigger breakdown, that's only going to be better news for Google, because the risk reward is going to get improved, and that next support and target is going to be sitting roughly at 152, where Google from a risk reward standpoint is actually going to be even better moving forward. Talking about Microsoft, and that is going to be the last one before, of course, Meta. And Microsoft also in a bit of a correction, down almost 10%, bouncing back higher pretty nicely, but a much stronger support. And similar to what we just analyzed for Google, for Microsoft, that area of support and demand is going to be sitting roughly at around $400 a share, with a very strong resistance at around 432 for Microsoft as well. So 432 resistance going into next week. Very strong support at 387 down to $401. And I've already shared the earnings volatility spreadsheet with everyone on Patreon, so you can access that with the link down below. But Microsoft reporting on Tuesday, July 30th, after the markets close, just over $65 billion in revenue, with just under $3 in earnings per share for the company. And last but not least, we got Meta Platforms, and Meta also reporting next week with a just over $39 billion in revenue expected, EPS of just shy of $4.82 here for the company. And right now we're seeing a lot of consolidation for Meta. Ever since the significant recovery from its low $80, Meta has now been consolidating sideways since the beginning of this year. Since February of 2024, it's really just been trading sideways, as you can see in that range, with a resistance staying put roughly here at 540 and a very strong support sitting right here at 420. So that's $120 range within which Meta has been fluctuating over the past 3 to 4 months. So those right there are going to be some levels to watch. Of course, if you do see a bit of a pullback after the earnings, wouldn't be surprised if it does, let's say, trade down to 420. And the resistance, like I said, the target's going to be staying put all the way up to $540 for Meta. And Meta is, again, one of those companies that does trade at a quite reasonable valuation. If you come over to fundamental analysis and ratios, scroll all the way down, 3.73 is going to be that M score, but it is trading at a forward P multiple of just under 23, and forward price to sales at just over 7.5 for Meta as well. So there you have it. That's the entire technical breakdown on the Magnificent 7 and, of course, the indices. The bottom line is that we're still within the context of a downtrend of lower highs and lower lows, with a lot of these stocks, a lot of these Magnificent 7 companies showing signs of weakness. And in case we get a breakout above those resistance levels, I'm not super confident that a reversal is fully in play just yet. The moment we see a breakout above those resistance levels, then I would be a lot more confident that, okay, we're now on our way potentially back up to all-time highs. But until then, I think we need to be cautious, because this has literally just started. I mean, the S&P is only down almost 4% from its all-time high. So it's possible that we do see a little bit more potential downside for the markets here, and of course for Magnificent 7. So hope you all enjoyed this video and found it helpful. If you did, make sure that you drop a like, and don't forget to subscribe to the channel. Links to our Discord and Patreon is going to be down below. There's a 51% discount available until the end of this month, so a few more days left. We'd love to have you on board, and as always, happy investing. I'll see you all in the next video.